Hey, Jimmy Slagle here with Dart Throw Trading, and I want to take a stab at this post that was put up in the options Reddit subreddit today. It's about a bear put spread that was put on, and the question basically boils down to, okay, I did this trade, the market moved the way I expected, trade didn't work out the way I anticipated, what went wrong? So let's take a look at the trade, and then we'll go through kind of what happened. There's a couple of things that I want to point out. First of all, trade was done on the VIX. Basically, the assumption, according to this post, was the VIX had gone up because of some events that were happening in the world. Now that it's gone up, it should come back down. So at the time this trade was placed, the VIX was trading at about 2135, and they believed that it was going to drop back down. Volatility would come out of the marketplace. So what they did was they purchased the 21 strike put and wrote or sold the September 18 strike put, which would basically become a very generic basic bear put spread. So the assumption is with the asset around 2135, it's going to drop below 18 sometime in the future. Now, the assumption that they're making in this trade is that it'll happen between now and the end of September and will stay below 18 moving to the third Friday of September. So they structured this trade. They said it was going to do the trade possibly in July or August, but they went ahead and did a September expiration. I'm not sure exactly why. Maybe to give it more time to move or whatever. But the feedback is, okay, so I've done this trade. It market moved in my favor. It did what I thought. Why didn't the trade work out the way I anticipated? So let's go take a look at why. Now, I don't know the exact date that they entered this trade. They said they did it in July when the VIX was trading around 2135. So I went back and looked at the past days because today's July 13th, just so everybody knows. And I wanted to try to figure out the exact day that they did it. So I'm going to make an assumption here. Please don't hold me to the assumption, but the assumption is that because they said the VIX was at 2135, I'm going to go back to July 8th. Today's the 13th. I'm going to go back to July 8th, and the reason is because on July 8th, the VIX actually closed at 2135. So that's the number that they had put in the post. So what I want to do now is take a look at what happened, because the benefit of hindsight is, okay, here's what we think is going to happen. Here's what actually happened. Let's take a look at what we could have done. So on July 8th, with the VIX trading at 2135, the assumption was the volatility index was going to drop back down. And in fact, they were absolutely correct. The 13th of July, which is today, the VIX closed at 1792. So, I mean, they were spot on what they thought was going to happen. This trade should have made money. Buy the 21 put, sell the 18 put. Market moves from 21 to 18. They should make money, right? They did, but not as much as they thought they might have, or many of you thought you might have, and let me show you why. So to do that, I'm going to click on this button up here titled Options, and what we have is, for lag times and everything like that, I'm just going to go straight to it. What we're looking at here are put options, and just right now we're looking at August expiration, which doesn't matter for what we're talking about. But what I want to do is what we call backtest, and I want to go back on July 8th and structure the trade and show you what it looked like the day they got in, and then what happened and why the trade didn't work out quite the way they anticipated. So to do that, I'm going to click on this button called backtest, and what it's going to do is ask me for a date. So we're going to go back to a starting date of July. We're going to go back to July 8th of 2015. And we'll let that bring in some data. And what this is doing, the software is doing, is going back and pulling in closing options quotes on July 8th for whatever months were available, whatever was available at that time. So we've got July, August, September expiration all the way out to January 2017. Now, in the post, the trade was for September. So let's click on the September expiration options, and let's build a trade July 8th on those September options. So we're going to go down to September 18th, 2015, which is 72 days out. Click on this. It'll bring up just the put options, because that's what we're talking about, for September expiration. And now let's go take a look at what the trade was. Now, according to the post, the trade structure was they bought the 21 strike put. It closed on July 8th at 288 bid by 294 offer, and they sold the 18 put, which was closed at $1.22 by $1.26. So standard bear put spread. So they bought the 21 put for 294 and sold the 18 for $1.22. So what we have is a standard bear put spread. Cost of trades $1.72. Now, let's talk about why this trade even makes sense to begin with. Well, the reason it makes sense to begin with is a couple of fold. Number one, if the market, which was at roughly 21 when they entered this trade, if the market decides to go down, what happens? Well, if the asset moves down, the trade's going to make money. If the asset moves up, the trade's going to lose money, and everybody knows that, if you know anything about trading at all. So now what we're talking about here is a slightly different scenario. If we enter this trade today, July 8th, when the asset's at 21, and the asset drops from 21 down to 19 to 20 down to 18, if we hold the trade till the third Friday of September, we're going to make maximum gain in the trade, which is the spread, 21 minus 18, $3 minus the cost of trade, in this case $1.72. So we're looking at about $1, I don't know, $1.28, $1.30 if we make maximum gain in the trade. So if you put a $1.72 in and you get a $1.30 out profit, that's not a bad trade. Spread minus cost. So that's close to 80% return in a couple of months for being right. Anybody can live with that. Here's what happened though. Yes, the stock moved, the VIX dropped, but it happened in 3-4 days. Different scenario, because in a 3 or 4 day move, we're not riding what we call the expiration curve, we're riding the entry curve. And the entry curve is a different animal. And the reason why the entry curve is a little bit more of a flat slope than the expiration, which is this more solid line, we're talking about the dotted line now, the reason this is more of a flat slope is twofold, well, threefold. Number one, when we enter this trade, it's a debit trade, so we're spending money to get in the trade. So if we get out of the trade early, well, we got to buy back what we sold and sell what we bought, minus commissions, minus bid-ask spreads, so we're going to end up with a loss. How much of a loss? Well, nothing major, maybe, $50 or so, when you're taking bid-ask spreads and commission costs. But if the stock moves in our favor, I keep saying stock, if the VIX drops, which is what was anticipated, we're going to make money in this trade, but it's a very slow make. And the question is, why? Why don't we make this maximum gain if it happens, in the short term? Well, the reason is twofold. Number one, time, theta. When you enter this trade and you go out to September, you're buying September options, you're selling September options, so you're negating the cost of time. Yes. However, if you close the trade prior to expiration, you have to buy all that time back, so to speak. So the only money that you make really is the theta decay from the moment you entered it until the moment you exit it, whether that's a week from now, 2 weeks from now, a month from now, or expiration. So the theta decay is going to be very, very small in a 3 or 4 day window of time. The second thing that's working against you in a trade like this is delta. When we enter a bear put spread like this, you're buying a delta. The 21 put has a delta. For every dollar the asset drops, you're making X dollars based on the delta. And you're selling a delta. So you have what's called a net delta in the trade. So your long delta is X, your short delta is Y. The end result is what we call the net delta. So let's take a look at that and see why this curve is so flat. So on entry, if we buy the 21 strike put, this 21 strike put has a delta of 41, which means, very simply stated, for every dollar the asset drops, this put should increase in value 41 cents, delta rate of change. The 18 put that we're selling has a delta of 25, which in theory suggests that every dollar the stock drops, or I keep saying stock, every dollar the VIX drops, we should make 25 cents in that put. Well, since we're selling it, that's a net loss. So the net result is we've got a positive 41 delta, so to speak. We've got a negative 25 delta. So the end result is, what do we got? 15 delta, I guess? 15, 16 delta. So what that tells us is, with a net 16 delta, every dollar the asset drops from 21 to 20, 19, 18 and on lower, we're making about 16 cents on our initial cost of $1.72, and the $1.72 is the $2.94 cost minus the $1.22, or our net cost of $1.72 in the trade. So when we look at this risk profile, the reason why we don't make any money as the stock moves in our favor in the short term is, number one, very little theta decay in the options that we're buying and selling, and number two, a very small rate of change on the delta position. So as the asset moves in our favor, we're going to make some money because it dropped all the way down here to 18, but now we're looking at maybe a $25 or $30 gain as opposed to $130, $140 gain if we held it till expiration. And the reason there's such a wide gap between what we can make today and what we would make on expiration is simply the theta and the delta of the position. That's why the trade didn't quite work out. So how do you fix that? A couple of ways. Number one, shorten your time frame, because the shorter the time frame, the less theta, or the more rapid the theta decay will become. And secondly, the shorter the time frame, the bigger the delta, net delta position will be. The challenge with doing that, as all traders know, is the less time you give something to move, the higher the chance is it can move against you. So I applaud the trader for going out till September, giving them enough time for the asset to move, but at the same time, if it moves against them, they've got time to adjust the trade and whatever. However, I probably would have chosen a August expiration as opposed to September. Still give yourself enough time for things to move, but at the same time, give yourself a little bit of grace if you're wrong to make an adjustment or whatever the case may be. So with that being said, once again, I'm Jimmy, dartthrowtrading.com. Come check us out. We'd love to help you out.